there's a lot of things that are pointing to a weakening economy. The banks are not really in great shape. We're seeing consumers with heavy debt. Credit card bills are above $1 trillion. I think U.S. savers, their savings is supposed to go negative next year. Here in the UK as well, our growth is anemic. We've got, I think GDP was up 0.6 on the year. And I would say the way they manipulate the inflation data, it makes it look better. Our deficits here are not, maybe not as big as in the US, but they're still running government deficits. Taxation is the highest in 70 years. So yeah, they want us to believe everything is fine, the economy is okay, but maybe for the top 1 or 10% of the people that are benefiting from this fiat currency financialization system, it might be okay. But I think for the general public, people on fixed income, especially pensioners, they're feeling the pain, I think, with the cost of living crisis continue to weigh on them. We're told that inflation has come down, but here as well, the ONS has changed the way they count it. Are we really supposed to believe that prices are only rising by 3 or 4%? I don't.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Mario Ineko. So, Mario, thanks so much for joining the podcast today.
You're welcome. It's nice to be here.
Yeah, and I'm looking forward to our conversation because a lot's happened since we last spoke, sort of about 6 months ago. And I think the economy has held up quite a lot better than everyone's thought, or at least it seems that way. So what are you currently watching, I guess, in the economy and in the markets at the moment?
Yeah, I guess the U.S. economy is statistically doing well, mainly because they're doing a lot of deficit spending, and GDP is usually calculated in a way that they add government spending to it. So I think it's a bit of a artificial thing. And the other thing is the stock markets seem to be doing well. And people think that when the stock markets are doing well, the economy is doing well. But I think there's a lot of things that are pointing to a weakening economy. The banks are not really in great shape. We're seeing consumers with heavy debt. Credit card bills are above $1 trillion. I think U.S. savers, their savings is supposed to go negative next year. Here in the UK as well, our growth is anemic. We've got, I think GDP was up 0.6 on the year. And I would say the way they manipulate the inflation data, it makes it look better. Our deficits here are not, maybe not as big as in the US, but they're still running government deficits. Taxation is the highest in 70 years. So yeah, they want us to believe everything is fine, the economy is okay, but maybe for the top 1 or 10% of the people that are benefiting from this fiat currency financialization system, it might be okay. But I think for the general public, people on fixed income, especially pensioners, they're feeling the pain, I think, with the cost of living crisis continue to weigh on them. We're told that inflation has come down, but here as well, the ONS has changed the way they count it. Are we really supposed to believe that prices are only rising by 3 or 4%? I don't. And I think that for things to get back to where they were before 2020, we'd have to see negative CPI so that the pound in our pockets buy still would go back to buying what they used to. So yeah, that's the way I see it.
Okay, that makes sense. And I know they've actually changed how they measure GDP as well. So I don't know if that's having an impact on in the US potentially that they've changed that. So now it's looking like they're growing a lot.
Yeah, I saw a headline, I think, recently that they're going to experiment with that in the UK. I'm not sure about the US, but I definitely know they changed the way they calculate CPI back in May 2022, and it's had a pretty significant impact on the data. For example, from 1997 to 2020, the CPI averaged 2.7%. And now, if you go back to the Bank of England calculator and they have to use the new methodology, it only averages 1.9. And it makes it seem like the Bank of England actually uh, did a good job in keeping CPI below their target, which is totally a lie. I'm sorry to say. Of course, they're not going to call it a lie. They're just going to say that they changed the methodology.
Yeah, it sounds like them. Have you been surprised maybe by how markets have held up and the economy has seemed to hold up, or is it just sort of what you're saying that as they run massive deficits, it's going to keep things moving at least in the short term?
Yeah, I mean, recently bonds rallied. They have rallied in the last month, so that's helped the financial markets, stock markets a bit. But if you look at the indices like the S&P, apparently, and I don't follow them, that closely, but there's only a few stocks that have done really well, these magnificent seven. So the S&P is up about 16% on the year. It seems good. But if you look at another index, which is like the MSCI world, not world, but weight traded index for equities, it's only up like 1 or 2% this year. It's not up that much. So yeah, again, things don't seem to be, the headlines and the indices seem to be pointing to things being good, but I don't think they are that much. And I don't think it's over for interest rates in terms of going up. They have stabilized and come off, but I've been saying, for years now that I think we're in a bear market for bonds, so that interest rates will keep going up, or yields will keep going up higher. And what we're seeing now is just a correction, I think, in the bear market.
Okay, so then that would mean that inflation's remaining high, but I guess as you said, they're changing how CPI is measured. So maybe will it have to be actual CPI remains high for bond yields to continue to rise, or could it be, you know, the inflation that maybe isn't captured by CPI?
Looking to add to your gold and silver stack or start stacking? Check out these specials at Miles Franklin and make sure you tell him that Monaco64 or Mario sent you. Well, that's the other thing I always talk about, and you probably have heard me say that inflation is really not the CPI, it's the creation of currency and credit. And if you look at M1 and M2 in the US, they have come off in the last year and a half, but from 2020, we're still at massively above those levels. So there's still inflation in the system. I guess CPI is what people look at, the bond markets. So if we have a turnaround, maybe in energy or other components of CPI, if they turn back up, we could see, CPI go back up in terms of the rate of growth, and that could impact bonds. But I'm not sure what it's going to do. But I just don't think that we're we're going to go back to the environment where bond yields keep going lower and lower. I think it's going to be the other way, and we could still drop a little further, but the direction is higher. But yeah, what will drive the CPI is difficult to say, but there's a lot of liquidity, as I said, and with yields going down as well, that encourages financial institutions to leverage more, and that creates more liquidity in the system, and that will result in more and more, money out there, I would say.
Okay, that makes sense. So, did you see? Because I guess a lot of people are saying that the economy is potentially going towards a recession. Is that something you see? Do you think maybe we're already in a recession?
I mean, I think it was in 2022, the U.S. economy, or yeah, it was in a recession the first 2 quarters, but they changed the definition. Um, yeah, the the markets definitely seem to be saying that, with the drop in yields, not just long-term yields, 2-year yield has dropped a lot. And with some of the economic indicators now looking weaker. Yeah, it's possible, but it's also an election year in the US and in the UK next year. So you can bet that despite the fact that the Fed's been, relatively, tight of late, they're still doing QT. You can bet that maybe the Congress or the White House, they'll push for more fiscal spending because I think that's one of the reasons why the economies have kept going. So anything's possible. They can fudge the numbers as well. Again, we could have negative GDP for 2 quarters, but they could change the unemployment numbers and say, look, unemployment is still low. That's what they did in 2022. So we don't have really a recession. But I think it's kind of irrelevant. I just think the general population is suffering. And yeah, I think Biden said the other day he blamed the companies, corporations for keeping prices too high. He said, wow, inflation has come off, so you need to cut prices. But in my book, the only people that can create inflation, one is the central bank, and the other is the federal government, because they scratch each other's back. It's not corporations. They're just reacting to a weaker currency. They're earning less in real terms, and they're paying more for the inputs, and that's why prices go up. So yeah, as I said, I don't think it's that important if there's a recession or not, but I think people are feeling it.
Yeah, and I don't think I've seen a double comment from a president saying that inflation's at three, it's still at 3%, so prices still rising, but companies need to put prices down. It was just, yeah, it was quite ridiculous. But yeah, as you said there, it's there's going to be that fiscal support moving forward. So then do you think that maybe the big seven can continue to keep going up? So maybe the stock market, or at least the S&P 500, will continue to go up as well. There's going to be a greater concentration, or do you think maybe that has to end soon?
Well, to be honest, don't really care much about the stock market because I'm not really invested that much in it. They could keep going, markets, can do things that seem irrational for a lot longer than people expect. I remember in 03, 04, most people were saying, these markets can't keep going up, but they kept going for another few years. Yeah, eventually these magnificent seven, they will turn around, and yeah, they'll have a huge impact on things because the other components are not really doing that well. When they do it, I'm not really sure. Maybe if bond yields start rising again, they could.
Okay. So what assets are you sort of focusing on? Precious metals and real assets at the moment? Is that your main focus?
Yeah, I'm always of the opinion that investment is not just buying securities in the stock market or bond market, is investing in yourself, and also in your family and helping friends maybe. But if you're fortunate enough to have extra savings, yeah, I'm sticking with real money, physical gold and silver, a little bit of miners, gold and silver miners. I think commodities, hard assets are interesting as well. I think the world is focused too much on technology and finance for too long. And even if we see, a correction in the overall market, you could see a lot of people trying to find alternatives. And that's why I think, gold, silver, and hard assets, commodities are a good place to be. Um, but yeah, I would say ultimately we are in a situation where gold and silver become like investments because the monetary situation is really precarious, in my opinion. They've inflated so much the system that gold and silver become like an investment and not money, only because the fiat currencies lose a lot of value. So yeah, that's how I see it. I don't look at crypto that much. I know people always ask me, but you have to choose one over the other. Some people say, oh, you choose both. And I know Bitcoin has gone up a lot, but I'm sticking to hard assets.
Yeah, okay, that makes sense. And if we look at gold, it's had a breakout above its all-time high, so it's looking like it's in a pretty interesting place. Why do you think we've seen such a increase in golds, despite, because normally I guess people think it's a hedge against uh maybe recession and other negative effects, but it's actually going up at the same pace as the stock market is.
Well, maybe because gold knows that they're going to have to keep inflating the system. Some people think they might want to bring it down in a deflationary collapse, but I think politically that would be really difficult because you let everything go down like that, you have a Great Depression very quickly, and politicians don't like that. So I think that's what gold is saying, that uh, ultimately they'll have to pivot, as it's called. And the other thing is, yeah, I think the market doesn't buy a lot of these CPI numbers, investors. And even though bond yields have gone up, real rates are not as big as people think. And I guess also all the other central banks, non-Western central banks, they're loading up on gold at a record pace in the last 2 years. So that's keeping the price of gold quite elevated. But the other thing I tell people, you go back, you look at how many grams of gold you could buy 70 years ago in dollars. Now you can buy 99% less. So fiat currencies, as I've said many times, they always go to their intrinsic value of zero. So that's the other reason. And the problem is that most people in the mainstream economic press and economists, they don't look at gold and silver as money. So I'm seeing a lot of people saying, "Oh, it's puzzling that gold is going up," but to me, it's not.
Yeah, it's a good point because I think, I guess you could say in the 70s it was used as a bit of a safe haven, but now many people are using bonds in the past, at least 30 or 40 years, but that has been quite terrible in the past year, at least with the yields increasing. So maybe there's a shift back to gold being used as a safe haven because, the value of bonds has depreciated so much because of rising yields.
That's right.
Yeah, so that's really interesting. Okay, so and I think it's a key thing where only a small percentage of assets are actually in precious metals as well. So, if I'm not mistaken, yeah, was it 10 trillion, or there was a certain amount of how much has been invested in gold versus other markets. So there's still room to go for there to be more, yeah, higher price.
Yeah, I think there's some statistic that came out recently that 70% of fund managers have less than 1% of the assets they manage in gold. So yeah, it's very, very small. And the same thing goes for silver, of course, and the miners. And even if you only have a small percentage of all the funny money that's been created go into that sector, it's going to make it really yeah, and make a big difference on the value of those assets.
Agree, good point. So Mario, thanks again for your time today. I appreciate it. My last question is, what is one message you'd like people to take away from that conversation?
One message, keep your head down, try to get out of debt as much as possible. I think there's a lot of people worried, especially here in the UK, where we don't have 30-year mortgages, what what they're going to do when their mortgages come due, maybe in a month or 6 months time. Yeah, maybe try to fix some of it. It's not advice. But as I said, just try to pay it off, live within your means, and don't buy into the mainstream narratives, I would say.
Good point. Yeah, it's easy to live with the Joneses and try and keep up with everyone with the clothes and the cars and everything they have. But sometimes you need to take a step back and, as you said, just be frugal, and you can still live a good life.
Yeah, you can have one car instead of two or three, and that's still okay.
Or a Ford instead of a Porsche. Not that I'm in that position, but yeah, that could be the changes. But yeah, Mario, thanks again for your time.
You're welcome.